Hey everybody, it's Randy Patrick. Time for another real estate housing bubble 2.0 video. Lots is always happening every week now in our industry. Got to keep up with things. It's getting tougher to do that. I should have done it on Friday, but I held off over the weekend just because I thought it was a little bit important, I guess, to say what or explain what's happened over the past decade. So, believe it or not, as of this weekend, it was the 10th anniversary of the collapse of one of the largest investment banks around, the Lehman Brothers. So there you go. So obviously that was a major thing that happened a decade ago, if you can believe that. I mean, I don't know what you were doing 10 years ago. I was personally working in the distressed property market, doing a lot of short sales. That's, so for me, I was very, I guess, in tune as to this news and thinking what is, what's going to happen to our marketplace, and it resulted in a lot more issues for a lot more people and a lot more opportunities to buy and sell real estate if that's something that you were looking for or you're into at that point in time. Now, the Lehman Brothers failure is kind of synonymous with the whole 2008 financial collapse. Obviously, there's more to it than just that, but it's kind of like that sort of started the true, we'll call it, housing crash crisis that happened. I mean, values were already dropping, but this was one of those things that just kind of put it over the edge and kind of put everybody on notice as to what was happening in the world. Now, the Lehman Brothers, they were involved in obviously mortgage-backed securities, the collateral debt obligations known as CDOs, and obviously they extended into the loan origination marketplace as well too, and they acquired about 5 lenders over that time frame. And example, Aurora Loan Services and BNC Mortgage, among others. And these were all lending groups, companies that specialize in, guess what, subprime mortgage origination. So that was the scoop. So these guys jumped in it, all the way in from both the investment bank side and the origination side, and they were focusing on one of the things that started the whole financial collapse. So obviously, as the housing market did start to change after its peak in 2006 and kind of started to slide in 2007, the Lehman Brothers actually increased the real estate's holding in 2007. So the signs were there. If you were looking, you could see some of the values dropping, some things were taking place. And I distinctly recall, our foray into what was the short sale marketplace at the time, our first kind of attempt at, talking to real estate agents and offering really, really low prices on listed properties was met with a lot of harsh comments and criticism and outright disgust. Because they said, oh, this is just a blip in the marketplace, a 2-month correction, we'll get out of this. Well, guess what? That didn't happen, and everything else is history, as you already know. So basically, Fortune magazine declared in 2007 the Lehman Brothers to be one of the most admired security firms that were out there. So of course, again, people were not really looking at the mortgage meltdown or not caring at that point in time. So again, they just kind of kept going on and on. Now the Feds had their, of course, too big to fail policy, and this did not work out for Lehman Brothers because they did not have the collateral needed to get a bailout. So there's some debate as to what really went on behind the scenes, but in the end, the government said we cannot, do a bailout without having some security, some collateral behind us, and therefore, basically, after billions of dollars in losses and write-offs, etc., and having their stock plunge 97%, the Lehman Brothers closed their doors on September 15th, 2008. So it's just over 10 years ago. So a lot has happened in 10 years, and we've seen a lot of things go on. So if you want to learn more about this, watch this movie. And again, I'm not plugging this for any personal gain here. It's called The Big Short. Some of you may have seen it. Some of you may have seen pieces of it, because if you type in The Big Short on YouTube here, you're going to get little clips, and the clips are kind of interesting. That's how I first started to understand the movies. I was watching these clips, and eventually I got the movie. But it's a great movie with some pretty good cast members in it. It's got a little bit of dry humor and a good perspective on how this all kind of fell apart. But if you want to learn more about what happened at that time frame, watch this movie. And really, it's, again, behind the scenes. I really like it, and just the perspective of everything. It's fascinating, and really it's almost like an education movie as well too. It talks to you about things like collateral debt obligations and credit default swaps and things like that. Stuff that typically for the average person you never heard of before, you never get involved with. So good education and some fun in it as well too, but it gives you a real background from Wall Street as to actually what happened. Now, many economists are asking, so who is the next, sort of entity to collapse? And right now, people think it's Deutsche Bank. Deutsche Bank has a ton of assets out there, non-performing assets. And again, I'm not an investment banker. I'm not a financial dude on Wall Street, so I really can't give much other than commentary other than what I read that's out there. But I know from personal experience that Deutsche Bank still is involved with a lot of legacy loans that are still floating around out there from the last housing crisis. So there are homes, believe it or not, we're working on some right now that have mortgages from this time period that are vacant, and we're trying to short sell them. We're trying to do something with them. It's just a matter of bad record keeping, acquisitions, whatever. So people think that Deutsche Bank is the entity or the next, I guess, company, bank, whatever, investment firm that's most poised to collapse. Moving on from that, homeowners are sitting on approximately $6 trillion of available cash. And that's really interesting. So based on the past few months of our reporting on home values are reaching its highest peak since the last peak of 2006. The Case-Shiller Home Index shows 11% over the 2006 values. There's $6 trillion worth of equity sitting there, but it's not being tapped into for whatever reason. So now 44 million homeowners are in position to actually get cash out refis or do HELOCs, which are home equity lines of credit. So 44 million, I guess you could say, mortgages, homeowners could go to that well and tap that equity if they really wanted to. The $6 trillion worth is calculated at the end of June. And believe it or not, that sort of equity is 21% more equity than was at the, the pre-crisis peak of 2006. So just before 2006 started rolling down and losing, where we are today, we're 21% greater than that point in time, which is quite interesting. Now, believe it or not, home equity lending, which is still going on, so it's still out there. So when you say people aren't tapping into it, it's not like nobody is. Basically, home equity lending is actually down 3% from the same period last year. So sometimes the headlines are a bit misleading. So people are still taking money out, but just not at the frenzied pace, and we've seen a decline in that. Reasons why? Well, clearly higher interest rates, are having an effect. Are you going to refi your house once interest rates are rising? Not sure whether you'd want to do that or not. And also maybe a change in how homeowners view their homes, i.e. not like cash machines at banks, not like ATM machines. So that may be a little different mindset now. But again, a lot of money there, and I expect as time goes on, it sort of ebbs and flows. I expect more people will tap into that, and they just can't resist, so to speak. So, and again, realize that much of the last housing crisis was actually caused by refis, like cash out refis and HELOCs. Even though the mortgage meltdown and this whole issue, when you sort of go back in time with Lehman Brothers and all the bailouts and all the investment banks going declaring bankruptcy, etc. A lot of the start of that had to do with subprime mortgages, but the majority, so subprime actually only made up about 20% of all the chaos that went on. A lot of the bulk of the issues were people taking cash out and going underwater immediately, and also HELOCs as well too. So you're going to do improvements to your property, but you never did. You use the money to buy boats, cars, big screen TVs, toys, go on trips, whatever you needed to do, but you didn't use the money to improve your home. So there you go. So again, as I said, people are still suffering from this, even though this has happened 10 years ago. I said the refis and the HELOCs pushed the market over the edge, and realize, I'd said this in a previous video, but I want to reiterate it here, that we still have 5.5 million people who are seriously underwater on their mortgages. So what that really means is that if you're underwater, your mortgage is worth more than the appraised value of your house. That's a significant situation in a time where we're at $6 trillion equity, and we're 21% greater than the pre-crisis peak in 2006. So it's sort of hard to fathom, but there's still 5.5 million homes with seriously negative equity, not just negative equity, but seriously negative equity, which actually means that the mortgage is 25% more value than the appraised value of your house. So you own a home for 100 grand and your mortgage is worth 125, etc. So that's kind of where we're looking at here. So and again, realize that HELOCs at the time usually are interest only, variable interest rates for about 10 years, and after 10 years, if they're not paid off, they reset, and they reset under a fully amortized schedule. So over the past few years, like 2015, 16, 17, now to 2018, people with outstanding HELOCs that took them out 10 years ago are actually resetting now, and they're resetting at today's interest rate. So, if you took your equity line of credit out in 2008 and you're paying the nice little interest payment, guess what? You're out of luck now. Can you refi and do something else? Maybe. But what they're doing, the banks, the HELOCs are basically allowing you to go into a fully amortized loan at whatever rate structure is out there. So you're going to be paying more than you used to on your interest-only variable rate HELOC back in the day. That's a scoop now. So having said all this, what will cause the next sort of mortgage crisis, and how will this affect housing overall? Well, it's hard to say, because everybody asks what's going to be the straw that'll break the camel's back. Clearly, it's going to be a lot of factors that are going on out there. But I recently read an article that outlined some of the similarities between today and roughly 10 years ago. So let's put things in perspective here. We all can agree that housing prices are overvalued and we've hit the peak. So we've seen that. We've seen the Case-Shiller. We've seen lots of stuff going on with every metro market that's out there. And we all can agree that we are also seeing more inventory hitting the market now. I know in my own market, my own county, the amount of active listings are certainly up from last month. We're probably talking 5 to 7%. And my market here, we've seen price decreases across the board. My market itself had a 22% number of listings, had a price decrease. So I'm seeing that number always increasing, more back on the market, properties, etc. The summer selling season is over now, so we're going to see probably a lot more of this. Now, as time goes on, people will get nervous and drop their prices, and maybe drop their prices faster and be more aggressive, which will sort of convert the seller's market and now to more of a buyer's market, which is great. We may even see a resurgence in cash out refis or HELOCs, because again, those, we'll call it those loans, those structures are based on last 2 months ago's comparables. So let's look at the comparable solds from 2 to 3 months ago, which look really good, but nobody's looking forward to what's going to happen 6 months down the road or even longer. So you see, that's why people can still probably tap into that. I'm betting if they can't sell their homes or maybe get the numbers they want, they're going to go, okay, we're going to hunker down, but we're going to access that cash through a HELOC or a cash out refi, and they may be able to do so for a bit, and thus they're going to perpetuate the cycle, and they may be underwater in some time. So now, just like the last housing bubble and crisis, what we've noticed is that when values are at their highest, mortgage delinquencies are at their lowest, which seemed to make sense, right? You would go, well, if you're up here and then you have some problems, you can sell, and then no one's actually defaulting the mortgage, etc. Well, as values drop, obviously mortgages increase, or delinquencies increase, and the first ones to go are the ones that bought at the highest value levels. That's kind of what happens. And those are the people who have no equity. And why? Because they can't sell and they can't move on. So if you took a 3% down mortgage, that was sponsored by their government, and you had maybe a 43 or 50% debt to income ratio, you're really kind of locked into your house right now. So if we have, you can't sell your house without paying commissions and closing costs, because you're already negative equity, even from if you sold for what you bought it for. You're negative equity, underwater. So let alone the fact that if the market were to drop 10 or 15%, then you're underwater. So you see, right now we have this low level of default, and that is talked about in media and the industry, and it's designed to sort of give us a false sense of, I guess you could say, confidence in our market, saying, hey, defaults are low. Well, why? Because values are high. There's a correlation there. Well, basically, low level of defaults is not really an indicator or predicator of housing market issues or default risks. That's not the case whatsoever. Home prices are an indicator of default risks, which I thought was kind of interesting. And roughly, you take a look at the marketplace, a third of all people might own their homes free and clear. Okay, they have no issues. Next third of people have mortgages, but their mortgages have enough equity in them that they can absorb any sort of housing decline in market value, etc., not be hurt. But the other third are, technically speaking, over leveraged, and even like a 10 or 15% change in the market will cause chaos with them. So, being underwater really is a strong predicator of mortgage default and foreclosure. So given how the prices are inflated right now and how mortgage rates are climbing, the fact that we have, our government allowing 3% down and encouraging 3% down mortgages, a lot of other, subprime being back in full force. A lot of the non-banks are lending in full force now, increasing our debt-to-income ratio 43 to 50%. I mean, a lot of stuff's going on now. We're going to see some problems. So any drop in the average, values of homes in any given market will cause some chaos, especially the delinquency rates will increase, and we'll have a crisis all over again. So we are actually primed for that right now. We've stage 2 of the housing bubble is here. We've hit the peak. Now we're going to start seeing the fall, and then we're going to figure out as the next few months move on what the impact's going to be and how this is all going to roll out. But again, so low delinquencies in the marketplace have zero, meaning or effect as an indicator of the most risk for any vulnerable households that are out there. So everybody realize that the worst is yet to come. Position yourself for that. Don't buy at the peak of the market. Buy on the way down or buy at the lowest point. And let's look forward to seeing what's going to happen over the course of the next few months. And again, thank you for viewership. Thank you for the comments and subscriptions. And look forward to posting another video in maybe a week or so. Thank you.